Okay guys, welcome back. So this is our second part. The second method for our consolidated FS subsequent to our um, acquisition date would be the equity method. So for this, the equity method of accounting is essentially accrual accounting for equity investments that enable the investor to exercise significant influence over the investee. So, results of operations for equity method is we have the net income. So, we have entries for our net income, the dividends declared or paid, amortization of allocated excess, and impairment of uh, goodwill, and unrealized gain or losses on intercompany sales of property and equipment. Okay, so under this method, we record the investment at cost, adjust for earnings, losses, dividends, amortization, and impairment. Okay, the investor reports his share of the investee's earnings as investment income, and his share of investee's losses as investment loss. So we will have entries on this as we move forward in our chapter. Okay, increase the investment account for income and decrease for investment losses. Okay, the investment income under the equity method reflects the investor's share of net income of the investee, and the investment account reflects the investor's share of the investee's net asset. So, although the equity method is not a substitute for consolidation, the income reported by a parent in its separate income statement under the equity method of accounting is generally the same as the parent's share, okay, of the consolidated net income reported in consolidated financial statements for a parent and its subsidiary. This is the same with the reported net income determined under the equity method. So the equity method of accounting is often called as uh, one-line consolidation. The name comes about because the investment is reported in a single amount on one line of the investor's balance sheet, and investment income is reported in a single amount on one line of the investor's income statement. Okay? Except when the investee has extraordinary or other below-the-line items that require separate disclosure. So, one-line consolidation also means that a parent's company income and stockholders' equity are the same when a subsidiary company is accounted for under a complete or and correct application of the equity, and when the financial statements of a parent and subsidiary are consolidated. Okay? So, consolidated financial statements show the same income and the same net assets. Okay? But include the details of revenues and expenses and assets and liabilities. So, the equity method creates many complexities. One is it requires the same computational complexities encountered in preparing consolidated financial statements. So, the parallel one-line consolidation, yan, coverage permits us by making alternative computations of such key financial statements item as controlling interest. Okay? And consolidated net income and consolidated retained earnings. So, basic accounting procedures for applying the equity method are the same whether the investor has the ability to exercise significant influence or joint control over the investee, or the ability to control the investee. So this is important because investments of more than 50% are consolidation and require preparation of consolidated financial statements. Thus, the accounting principles that apply to the acquisition method of accounting for business combinations also apply to accounting for investment of 51% or greater under the equity method. So, technically, same accounting principles would apply either a significant influence or joint control or even a uh, controlling uh, interest. Okay? When accounting for investment under the equity method. However, yun nga, kapag 50% above na or more than 50% yung interest ng ating investor, so this is uh, um, this require preparation of consolidated financial statements. Right? Yan. So, for a table of comparison, ito yan. So, cost model versus our equity model. So, our investment balance, under cost model, we have, syempre, the cost. Under equity model, we have the cost, tapos yung shares sa net income, amortization, and impairment, ganyan. How, also, adjustment needed to eliminate. So, under cost model, ko-convert natin yung convert natin yung cost model natin into an equity uh, method as of the date of acquisition. Ayan. So, elimination entry. So, eliminate the beginning of the year balances and allocate allocated excess distribution. So, original amount from the schedule. Then, for equity method, we have the remaining unamortized balance. Okay, amortization of excess. So, for prior year, retained earnings, current year. Then, only current year to nominal account. And lastly, for goodwill impairment, prior retained earnings, only current year to nominal accounts. Yan. So, the amount in the consolidated financial statements are amounts appearing in the books of parent, okay, under the equity method, which ensure particularly the following aspects. One, the parent company's net income as reported is exactly equal to the controlling interest, okay, in consolidated net income of the consolidated FS. So the parent's retained earnings is exactly equal to the consolidated retained earnings. And the parent's common stock is exactly equal to the consolidated common stock. And also, the parents' additional paid-in capital, yung ating mga share premium will also be the same. The parents' companies dividend will also be the same. Okay? So, determination of the method being used. So, before you attempt to prepare a consolidated worksheet, you need to know which of the two methods is being used by the parent to record its investment. So, you cannot begin to eliminate the investment in subsidiary until it is determined. Siyempre, kailangan mong malaman kung cost model ba yung ginamit or equity method because they are transactions recorded under the equity method that are not present in our cost model, and we will have different treatment for those entries when we do the consolidated FS. Okay? That's for the use of the cost model. So, if the investment account will be at the original cost shown in on the schedule of determination, so it is a cost model. The parent will have recorded its share of subsidiaries income and its ownership interest in subsidiaries dividend declared. It is more in most cases this income will be called subsidiary dividend income. Okay, that is for cost model. So kapag hindi naman cost model yung ginamit, check for the use of equity method as follows. Yung investment account natin will not be at the original cost. So, nagkaroon ng movement yung ating investment account. Then, the parent will have recorded an investment income, its ownership percentage times the reported net income of the subsidiary less the amortization. Ayan. Kapag merong ganyan, the method used is equity method. Okay? Then, choosing between cost model and equity model, yan, consolidated FS amounts are the same regardless of whether the parent uses cost model or equity method to account for its subsidiaries operation. Although, there appears to have significant differences between the cost model and the equity method. Main difference is one, timing. Okay, eventually the flows of income that flow from each method are the same. So the cost model is slower in recognizing income kasi cost model only records the uh, income at the end of the period, okay, or at the consolidation date. Okay, the working papers eliminations using the two methods are different. Of course, yung ating elimination entries would consider all entries made under the equity method, while under the cost model, we will have a lump sum recognition of the transactions of the subsidiary. Okay? Yan. So the following table shows the impact of basis of measurement on goodwill impairment test. So we use impairment tests when using the equity method. Okay, because of the recognition of impairment of goodwill. So under the basis of measurement of non-controlling interest and goodwill impairment, so item we have goodwill in consolidated FS. So under non-controlling interest includes non-controlling interest, shares of goodwill, then non-controlling interest as proportion to I of identifiable assets at acquisition date. So at we have partial goodwill. Does not include the non-controlling interest shares of goodwill. Okay. The carrying amount of cash generating unit goodwill is allocated to cash generating units without further adjustment. While in our partial goodwill approach, goodwill has to be grossed up to include non-controlling interest share, notionally adjusted. Goodwill is equal to recognize goodwill divided by the parent's interest. Then impairment loss is shared between the parent and the non-controlling interest. Okay, while on our partial goodwill, impairment loss is borne only by the parent as goodwill is none. As goodwill for non-controlling interest is not recognized. Right, right? Right. Yeah. One item to be recognized under equity method is that the parent company might opt not to record the goodwill impairment loss. Okay? Yeah. So you may refer illustration 3-2, 3-4, and 3-6 in our book. So goodwill impairment test under PAS 36, impairment of asset uh, requires goodwill to be reviewed annually for impairment loss because goodwill is an integral asset in a business unit. It is not assessed for impairment as a standalone asset, but is reviewed for impairment as part of the cash generating unit. As discussed in Chapter 2, PFRS 3 allows two bases of measurement of non-controlling interest as of the acquisition date. Either the non-controlling interests are measured at full fair value or the full goodwill approach, or our non-controlling interests are measured at proportionate share of full goodwill or our partial goodwill approach. Yan. How is goodwill impairment loss accounted under equity method for consolidation purposes? And how is goodwill impairment loss handled? is goodwill impairment loss recorded. So the impairment loss is reported in the consolidated income statement for the period in which it occurs. It is presented on a before tax basis as part of continuing operations and may appear under the caption other gains and losses. The parent company would handle the impairment loss in two ways. One, the parent could record the impairment loss on its book and credit the investment in subsidiary account. Okay? So, this would mean that the impairment loss would already exist before consolidation procedure starts. The non-controlling interest share of the loss, in case of full goodwill approach, would be recorded on the worksheet. Okay? So, the procedure used in this text will be to follow option 1, which is uh, full goodwill approach, and directly adjust the investment account on the parent's book. This approach will be discussed in illustration 3-2 and 3-4 and 3-6. Then impairment loss could be recorded only another way in recording impairment loss. The impairment loss could be recorded only on the consolidated worksheet. The investment account resulting goodwill and the controlling retained earnings would be overstated. Thus, on the worksheet, an adjustment reducing the goodwill account and the controlling retained earnings would be needed. So, consolidated statement subsequent to date of acquisition. The preparation of consolidated financial statements after acquisition is not materially different in concept. Okay, so we have these steps that we are following when it comes to uh, preparation of consolidated financial statements. That would also be the same. Okay, so in the sense that reciprocal accounts are eliminated and remaining balances are combined. On the date of acquisition, the only relevant financial statements as discussed is the balance sheet. While after the acquisition, we have a complete set of financial statements to be considered. So, under the workpaper format, accounting workpapers are used to accumulate, classify, and arrange data for a variety of accounting purposes, including the preparation of financial reports and statements. Although workpaper style and technique vary among firms and individuals, we have adopted a three-section work paper for illustrative purposes in this book. So the format includes a separate section for each of the three basic financial statements: income statement, retained earnings statement, and balance sheet. In some cases, the input to the work papers come from the individual financial statements of the affiliates to be consolidated, in which case the three-section work papers is particularly appropriate. So, nature of eliminating entries. So, we have discussed this also in our previous chapters. The investment account must be eliminated in the consolidated financial statements because of a single entity viewpoint. A company cannot hold an investment in itself. Okay, so from a somewhat different viewpoint, the investment account on the parent's book can be thought of as a single account representing the parent's investment in the net asset of the subsidiary and so-called one-line consolidation. In full consolidation, the subsidiaries' individual assets and liabilities are combined with those of the parent, including both the net assets of the subsidiary as represented by the balance in the investment account and the subsidiaries' individual assets and liabilities would be double count and the same set of assets. Therefore, the investment account is eliminated and not carried to the consolidated balance sheet. To achieve the elimination of the investment account, eliminating entries are required. So, As previously discussed in our consolidated financial statements, the investment in subsidiary account will totally be eliminated. Eliminating entries are used in consolidation worksheet to adjust the totals of the individual account balances of the separate consolidation companies to reflect the amounts that would appear if all the legally separate companies were actually a single company. Okay? Yan. Eliminating entries appear only in the consolidation worksheet. Okay? And do not affect the books of the separate companies. So this is just for the consolidation purposes. Consolidated financial statements should include only balances resulting from transactions with outsiders. Eliminating techniques are designed to accomplish this. And so the consolidated income statement is essentially a combination of the revenue, expense, ayan. So the combined income of the affiliates after eliminating any intercompany transactions is referred to as consolidated net income. This amount is allocated to the controlling and non-controlling interest in the work papers. Ayan, consolidated net income is reduced by the non-controlling interest share of the uh, net income of the subsidiaries to arrive at the controlling interest in the consolidated net income. Consolidated net income under the entity theory, all revenues and expenses of the individual consolidating companies arising from transactions and actions with unaffiliated companies are included in the consolidated financial statements. Okay, so we also have consolidated retained earnings statement. So the consolidated retained earnings statement consists of the beginning consolidated retained earnings plus the controlling interest in consolidated net income, parent's company dividend declared, and non-controlling interest in net asset. It is reflected as a separate component of equity. Okay? So, work papers observation. Yan. So, you can read more on this. Ayan. So, for our illustration, I will discuss this more in our next recording. Okay? See you guys.